Let's get across the market open now. Josh Barker joining us from Barker Wealth. Josh, welcome back. Good to see you. How would you describe what we've seen on equity markets more recently? Because we have recovered essentially. Well, you look at Wall Street. Wow, new record highs.
Yeah.
Locally, we're yet to fully catch up. Nonetheless, also been pretty bullish.
Yeah, well, to me, I'd sort of categorise it as surprising. It's the sharp increase that we've had is not only, I guess, a sign of the sharp decline that we had, but also potentially just the strength in this US bull market, which we still remain in for the time being, which is I think the US market is in a very different situation to the Aussie market, and hence why we haven't really caught back up. But I think the main driving factor for the Aussie market going up has just purely been led by Wall Street's record close. Which is quite interesting because it's sort of diverged away the last couple of trading sessions from the actual oil price, which last night was up alongside the markets, and sort of hovering around that $100 a barrel mark has been a real magnet for the movements lately. Sort of any negative news, it really kicks on above it, and then when things settle, it goes just below it. But it's really a significant number, I think, and as long as the longer that price is at 100, really negatively impacts Australia quite a fair bit, probably the most.
In terms of growth?
Yeah, in terms of a slowdown and an impact on us. You've obviously got fertiliser that comes through a lot of that as well. So, that you've got the transport costs, fertiliser adding to food prices. And I think just given where we are in Australia's economy anyway, we had 2 rate rises before this even occurred, higher inflation. The one bright spot is the unemployment rate being low, but that could work as a double-edged sword. If that changes, then that's really the only glimmer of hope that we've sort of got at the moment. So I think, I think there's probably likely to be some significant slowdown later this year in the Australian economy once those numbers start to come through. And even in the ultra short term, we've got markets at pretty much all-time highs. It's pretty much pricing in that everything's going to be sorted out this weekend, which I think is quite optimistic. So I think that the risk is definitely to the downside in the short term. But here locally in Australia, I think it's a different story. I think the risk is to the downside in the medium term as well. So the next 12 months could be pretty ugly for ASX shares.
Are there any particular sectors you're avoiding? And I might point you towards those consumer-focused stocks, given consumer sentiment is pretty much at a record low. Yeah,
well, I think that's the obvious one. Anything that's sort of linked to the consumer. We saw a lot of this when we had this exact same environment coming out of COVID. So anything that, businesses specifically that aren't able to quickly adjust the prices that they charge and flow on. So if the key inputs increase and they're not able to pass those on straight away, then that's where they struggle. So some examples were some of the food companies like Ingham's and those sort of suppliers of food. So it doesn't have to be such a discretionary nature to it. It's more about the way that they can control costs, especially.
What are you viewing in tech at the moment? It's just over the last couple of sessions, it has rebounded significantly. Now, of course, we had that SaaS apocalypse, the big sell-off there.
Yeah.
Have you seen opportunity? Have you been weighing back in?
It's difficult because you are swimming against the tide with that one. You're sort of playing a short-term bounce in the sort of fear that's overcome a lot of those stocks. I think generally, and again, this is a really good example of the US being very different from Australia right now. The reason for a lot of those sell-offs is because of the developments in AI. So, for example, Claude or its parent company Anthropic potentially coming onto the market this year. That's probably going to slot right into the into the S&P 500, given its size that they're talking about doing that. And that's just going to continue to put more pressure on some of these Australian SaaS businesses. So I did see that Xero actually has an integration with Claude, or an announced that a couple of weeks ago. So that sort of was actually a little bit of a turning point for Xero specifically. So that's good. It can, sort of obviously benefit from those as well. But there is still that risk of a lot of these people just going around these software companies and just essentially building it themselves quite easily with these AI advances.
Now, Josh, how have you been playing energy? And look, specifically, obviously, yesterday we had that disaster essentially with the Viva oil refinery in Geelong. Let's start with that stock and what the likely, because it has been at a trading halt, you would expect it's going to take a hit.
Yeah.
How would you play it?
Well, it comes down to your view on the reoccurrence of these types of scenarios, right? It is very rare, and I think that's what a lot of politicians are saying. This is a 1% chance of occurring, and it just so happened to occur right now. So I think if you're confident that it's only 99% of the time it does well, I think it's a good area to play depending on the discount you're able to get. Obviously, you can see there on screen it's had a good year and particularly a good month over the last month or two. So I think that I think it's a good opportunity. It is a company that with its refinery makes really good profits and delivers back through earnings and dividends that come through to shareholders as well. So it's a little bit less speculative in that nature, and I think there's going to be a need for the onshore refining and probably government initiatives for that company to expand and push on and potentially open more refineries and stuff like that. So Australia's independence is something that's really in the focus at the moment. And I think this one's probably a beneficiary of that. So yeah, I'd closely be eyeing off the share price movement of that one. If you can get set in that position at a discount because of what's occurred, yeah, you're sort of hopeful that it doesn't occur again for the near term anyway.
Have you been holding positions in energy, the likes of Woodside or Santos?
Yeah, a little bit more directly. Like, for example, I came on a couple of months ago and spoke about the coal. We also have an international ETF by State Street that has a pretty large exposure to the Venezuela sort of thematic. So I think that's something that you can sort of rest assured whilst Trump's in that thematic's probably going to play out pretty well. So I think that there's obviously a lot of political reasons as to why everything's going on at the moment, but that's probably one of the biggest drivers. So I think that those sort of key holdings are what makes not only Australia but those areas are probably going to continue to do well despite the market struggling. Mining is probably going to hold us up. We had numbers coming out from China that were quite strong yesterday. So those sort of key staples like iron ore and things like that are probably going to hold up our market. But yeah, a lot of pain is probably likely going to occur over the next 12 months, unfortunately.